If I had $1,000 to invest today, I wouldn't buy random stocks, and I definitely wouldn't gamble it on crypto. Instead, I'd follow a simple strategy that many beginner investors completely overlook, and it could make a huge difference to how that money grows over time. A lot of people want to start investing, but the biggest problem is knowing where to begin. There's so much information online, stocks, crypto, trading strategies, that it can feel overwhelming, especially if you're just starting out. The truth is, you don't need to be a financial expert, and you definitely don't need thousands of pounds to begin investing. Even $1,000 can be a powerful starting point if you use it in the right way. So in this video, I'm going to show you exactly how I would invest $1,000 if I was starting from scratch today, using a simple strategy designed for beginners. And if you want to learn more about building income streams, investing smarter, and growing your wealth over time, make sure you subscribe to Capital Foundry. Now let's start with the first thing I would do before investing that $1,000. The first thing I would do before investing that $1,000 is make sure I'm not investing money I might need in the near future. One of the biggest mistakes beginner investors make is putting all their spare cash into investments without having any kind of financial safety net. Investing is powerful over the long term, but in the short term, the value of investments can go up and down quite a lot. That means if you suddenly need that money for an unexpected expense, you might be forced to sell your investments at exactly the wrong time. For example, imagine investing your entire $1,000 today. Everything seems fine, but a few months later, your car breaks down, your boiler stops working, or an unexpected bill arrives. If the market happens to be down when that happens, you may have no choice but to sell your investments at a loss just to cover the expense. This is why many experienced investors recommend building at least a small emergency buffer before putting money into the market. That buffer acts as a safety net for life's unexpected costs. It doesn't need to be huge at the beginning. Even setting aside a few £100s for emergencies can make a big difference because it means the money you do invest can stay invested for longer. And that's really the key idea here. Investing works best when you give it time. The longer your money stays invested, the more opportunity it has to grow and compound over the years. Once you've made sure you have a small financial safety net, the next step is avoiding one of the biggest mistakes beginner investors make: chasing hype. When people first start investing, it's very tempting to look for the fastest way to grow your money. Social media, news headlines, and online forums are full of stories about people making huge profits from individual stocks, cryptocurrencies, or risky trades. The problem is that what you usually see online are the success stories, not the thousands of people who lost money trying to do the same thing. Many beginners jump into investments simply because they hear someone say it's going to skyrocket. They buy into hype, hoping the price will keep rising, but by the time most people hear about an investment trend, a lot of the growth has already happened. This is why experienced investors often say that investing isn't about trying to get rich quickly. It's about building wealth slowly and consistently over time. For example, someone might see a stock trending online and decide to invest their entire $1,000, hoping it will double overnight. But if the price suddenly drops, panic can set in, and they end up selling at a loss. Instead of chasing the latest trend, a much smarter approach is to focus on simple, diversified investments that have historically grown steadily over long periods of time. The strategy I would use for most of that $1,000 is investing in something called an ETF. ETF stands for Exchange Traded Fund, and it's one of the simplest and most beginner-friendly ways to start investing in the stock market. Instead of buying shares in just one company, an ETF allows you to invest in a large collection of companies all at once. This is known as diversification, and it's one of the most important principles in investing. For example, some ETFs track major stock market indexes like the S&P 500. That index includes around 500 of the largest companies in the United States, companies like Apple, Microsoft, Amazon, and many others. When you invest in an ETF that tracks the S&P 500, you're essentially spreading your investment across hundreds of companies instead of relying on the success of just one. This reduces risk compared to buying individual stocks, because even if one company performs poorly, the overall investment is supported by the performance of many others. Over long periods of time, diversified index funds like these have historically produced steady growth as the global economy continues to expand. For a beginner investing their first $1,000, this type of approach is often much simpler and less stressful than trying to constantly pick winning stocks or follow the latest investment trends. Once you've invested that first $1,000, the next step is something that can have an even bigger impact over time: investing consistently. Many people think investing is about finding the perfect moment to buy into the market. They wait for the right time, hoping prices will drop or that they can predict where the market is going next. But in reality, even professional investors struggle to consistently time the market. That's why many long-term investors focus on something much simpler: investing regularly, regardless of short-term market movements. This strategy is often called dollar-cost averaging. It simply means investing a fixed amount of money at regular intervals, such as every month. For example, imagine starting with $1,000 and then adding $100 or $200 each month into the same investment. Some months the market will be higher, and some months it will be lower, but over time your investments begin to average out. The real advantage of this approach is that it removes the pressure of trying to perfectly time your investments. Instead of worrying about short-term fluctuations, you focus on steadily building your investment portfolio over time. And when those regular investments are combined with long-term growth in the market, something very powerful begins to happen: compounding. The final step in this strategy is something that many beginner investors underestimate: thinking long-term. When people first start investing, it's very easy to become focused on short-term market movements. Prices rise one week, fall the next, and suddenly it feels like every small change is something to worry about. But historically, the stock market has always moved in cycles. There are periods where markets grow quickly, and there are also periods where prices fall or move sideways for a while. What matters most is not what happens over a few weeks or even a few months, but what happens over many years. Investors who focus on the long term tend to benefit from the overall growth of businesses and the global economy. Over time, companies innovate, expand, and create more value, and that growth is reflected in the stock market. For example, someone who invests $1,000 today and continues adding money regularly over the next 10, 15, or even 20 years gives their investments the opportunity to grow through both market ups and downs. This is why patience is one of the most valuable skills an investor can develop. Instead of reacting to every short-term movement, successful investors stay focused on their long-term goals and allow time to work in their favor. So if I had $1,000 to invest today, the strategy would actually be quite simple. First, make sure you have a small financial safety net so you're not forced to sell your investments when unexpected expenses appear. Second, avoid chasing hype or trying to get rich quickly with risky investments. Third, focus on diversified investments like ETFs that spread your money across many companies instead of relying on just one. Then continue investing consistently over time and stay focused on the long term. Investing doesn't require perfect timing or complicated strategies. What matters most is starting early, staying consistent, and giving your money time to grow. If you found this helpful and want to learn more about building income streams, investing smarter, and growing your wealth, make sure you subscribe to Capital Foundry. Thanks for watching, and I'll see you in the next video.